Okay, Chapter 11, Current Liabilities and Payroll Accounting. Understand that we're only going to cover the current liabilities, not long-term. Long-term will be covered in Chapter 14, which is actually a very demanding chapter. Okay, so let's define the liabilities. Due, past due, right? It's what you owe. And current liabilities is anything less than a year when it's due, 0 to 365 days. So it's a legal and financial obligation here. And we have to separate it from long-term liabilities. And again, that distinction is 1 year or the company's operating cycle. I'm not going to go into that kind of technicality. There are some industries where there's some differences. That's very specific, and so for test questions it'll be just 1 year less or more, which separates current from long-term liabilities. Current liabilities can be a huge component for companies because they're financing their inventory, their accounts payables through trade credit, and so it can be significant. And here they're talking percentages. As you can see, like Columbia Sportswear, it's over 80% of their liabilities. So it's a large component of financing for corporate financing. There's a variety of ways and people that do contribute to that financing. So sometimes there's an uncertainty of liabilities, whom to pay, when to pay, and so forth. And so it's not, we're going to talk about known liabilities. And so the known liabilities are accounts payable, sales tax payables, unearned revenues, short-term notes, payroll's a big component, and then multi-period known liabilities. So let's go into see if they talk about each one. Yes, they do. So let's talk about accounts payable, since they didn't have a slide on that. Accounts payable is credit that's offered to you usually through the industry. So your suppliers are allowing you terms like 30 or 60 days to pay on when you order any goods or services. And so this can be a huge component of corporate financing. Sales tax payables. Many state governments and possibly in the future federal government make corporations collect taxes for them. So when you make a sale, like you go to Loaf and Jug or a grocery store and you buy something, they're also collecting on that sales tax. Well, then that company now has an obligation to pay that to that state, and they'll record that. They might pay once a month or once a quarter to the state, whatever they've collected for that period. Unearned revenue. Again, the term revenue confuses a lot of students. They see it and they automatically think it's a revenue account. But unearned revenue is where you've received cash for some future delivery of some service or product that you haven't delivered yet. And so you owe them something. You might not owe money, but you owe them a service or a product. So that is still a legal and financial obligation. And so it's recorded as a liability. Examples of unearned revenues, we've talked about this before, so it shouldn't be that new to you. Like magazine subscriptions, rent paid in advance, maybe season tickets at sporting events, airline tickets, the things that you pay now but use later, that kind of thing. And again, you just simply remark it as cash you've earned, and then you have unearned ticket revenue, and then when they attend that concert or that event, you now transfer it down and make it as actual revenue. So that liability then turns into revenue once you've delivered. Short-term liabilities, I think they're talking about short-term notes here. And note payable. These are obligations that are in written form. And an example would be maybe you sold some equipment, or maybe you had a customer that was an account payable, got slow, and now you're converting that to a note. And the reason why you want it in a note is it has a stronger in legal actions for legal recourse, and the courts will recognize that as a stronger obligation. And so it's also used, like I said, for short-term or even long-term financing. So notes are common. You might have notes to your employees if you're lending to employees and so forth. So, and usually with that note is the borrower is paying interest, and that's specified in the terms of the note. And again, you'll have you might be extending terms to some customers as an example. And again, you notice that they're making it a 60-day note. You're noticing they're putting down the terms for that note. This is 1% a month as an example. Extended period, you're going to have now an interest expense. Maybe that'll be as a revenue if you're earning that interest, or interest payable if you're incurring that interest expense. Here's an example of a promissory note. They tell you how much you're borrowing, the date that it was executed, the term, who it is from. Maybe should be usually some person's name should be, or company, plus an interest rate. And you notice that they're saying an annual rate, even though you're only borrowing for 60 days. It's just a way of calculating, and then it's spelled out. So it's sort of like a check. Usually they're a little bit more expensive than this. There might be some other terms. But there are some standard notes that you can get from legal sources and so forth. You might get it from a bank. Same thing, you're just going to record it as a note payable, and then you receive cash. And then you have interest expenses that are going to be incurring. So you have to record this. Again, notice the terms here that they're spelling out. 60-day, 12%, here's the principal. And usually what you're spelling out is the term, the rate, and the amount. End of period adjustments on notes. So whenever you have a note and there's interest, you've got to be able to calculate it. Well, how much did I have to incur for an interest expense? And you'll have to count the number of days for that period and then multiply it times the principal times the period and the time. And to calculate that, it might be, example, $10. And here you have an interest expense, but you didn't pay it on December 1. You're going to pay it maybe later at some point in time, but you still incurred that expense, and that has to be recognized, and then the payable is recognized. And here they're obviously paying it now, so you can see they're paying out $2,040. $2,000 was the principal, $10 was the prior interest period, and now the $30 is the current interest period for a total of $2,040. So you're going to have to keep track of both the current interest and the payable for the period of time that was incurred in the prior period. Payroll liabilities is a huge component for companies, and there are a variety of things that go into the payroll account. In fact, this can get quite complex, and most companies of any size typically use an outside vendor to do their payroll because it is rather complex and so forth. And so a lot of times the bookkeepers or the CFO is not doing it. They've hired this out to a third party. So, but there are a variety of payroll deductions, and you might see this in your own check. It starts with gross pay, whatever you made for that period, and then the company might withhold a variety of deductions. They will obviously withhold federal income tax that they are going to send into the IRS. There might be state and local taxes. Now you have your net pay, and then you have maybe voluntary deductions. Could be for charity, could be other insurances, there could be some taxes taken out. So there could be a variety of things that the employer will have to deduct and then pay various entities here. And you have to keep track of all that. Social Security. And you can see that they're charging 6.2% for the first 110,000, and then it stops after that. Whereas Medicare is 1.45 of all wages earned. And some of these rates and amounts will change over time through legislation. And this is one of the reasons why companies use third party, is so they can keep track of that. But the employer withholds this, including taxes, and then pay these various entities at a later date. Again, federal income tax, state, local taxes, those are some of those deductions that occur, as well as some voluntary deductions. It could be union dues, maybe they're setting up a savings account, retirement accounts, insurance, charities, They might even have a Christmas fund that they're saving for, things like that. And these are voluntary, but the employer holds these back for the employee. And you can see here's your salary expense, and then you're deducting certain things from the employee, and then this is what you pay the final net to the employee. Well, you can see here it's almost 25% reduction of their pay. Payroll taxes that the employer has to pay, they have to pay some of these. Social Security, the Medicare, the federal and state employment. This is over and above what you deducted for the employee. The employer also has to contribute this amount. And this will be a separate journal entry for this. So yes, you're withholding for the employee, but you also have additional taxes to pay for that for the employee, but not the employee paying it. You are. So the government's getting it both from you as well as the employee here. And you'll have to keep track of this. Federal unemployment tax, state unemployment tax examples. And so you're going to have payroll taxes, and then you have a variety of these. These are over and above what the employee paid. You're paying this per employer, per employee. And so a lot of times employees don't understand just how expensive they are to the employer. And sometimes it's good to educate them that their salary is not the only expense that you have to cover as the employer. Multi-period known liabilities. This includes obviously unearned revenue and notes payable. But let me give you an example. You buy a car. Well, you might pay for 4 years on that. Well, multi-period says you're going to be paying monthly for 4 years, so it's a multi-period. And you think about it, for a 4-year car loan, well, we have to separate what's current and long-term. You're going to have 12 months of that loan in the current section and 3 years in the long-term. It's not, even though it's only one note, some of it has to be recorded as current, and some of it is long-term, and sometimes that confuses the student. I'm going to stop here, and then I'll start with part 2 on another video.